Hello and welcome to the Moving Market Podcast. I'm J.R. Gondeck, and as always, joined by David Sokolovsky. David, let's look to the rough April, discuss maybe some of the implications, and look ahead to the rest of the year.
Sure, Jared. So I think as you pointed out, April was a difficult month for both equity and fixed income markets. The S&P was down around 4% for the month, reversing a lot of the gains from March. And you saw, if you look at small caps, they've really erased a lot of the gain for the year. The trend that we did see that's a little bit more optimistic is that value outperformed growth for the second consecutive month. And the question for us is that trend really going to continue? The S&P is now up nearly 5% for the year. Emerging and developed markets continue to lag for the year. But again, another area of optimism is the gap is narrowing between the equal weighted index, which we watch very closely, and the S&P 500. So what we're seeing is really the breadth of the market. The rest of the companies outside of the handful of very large tech names are starting to perform significantly better. And as you look to the bond market and past some of the equities, you see that the bond market continues to be negative for the year. It's down about 3% on the year. And this is where duration management and individual bond selection becomes so important because you're able to maintain positive income if you can avoid the price movement that you're seeing with a lot of these bonds in the face of rising interest rates. And lastly, if you look at dividend paying companies, energy, utilities, and others, they had a very strong month relative to the market as well. And so again, we'll see if that trend continues, really focusing on value and earnings and profitability starting to matter a lot more. So the question then for you, JR, is, will this correction from April continue into May?
Well, if you look, David, it was the first down month really since October. So the market had been on a pretty strong rally overall. Again, a lot of it contained the momentum names up until recently. You're starting to see more of an even recovery. But again, looking ahead, I mean, the two big things obviously we're focused on are inflation. So if you look, we have a couple weeks away, a week and a half away from the next inflation data point. So if you kind of look quickly as to, what's ahead in what numbers are rolling off, it's interesting to see. So if you look at this next data point on the chart, April from a year ago was 0.4. So it's a higher than expected number for the data point we're going to receive. So likely headline inflation will fall a little bit. And again, when you look at the month of April, there were a lot of first quarter concerns that inflation was higher than expected, both from wages, consumer prices across the board, and the markets really reacted pretty negatively around that. And the same now as you look to the Fed. What does the Fed do with kind of the challenge you have with inflation? They're concerned, obviously, the first quarter was higher than expected. And, this higher for longer on their interest rate policy is going to persist longer. Because again, it wasn't more than 4, 5, 6 months ago, we were expecting as many as 6 rate cuts this year. That got as low as 1 or even 0 in the month of April. But now as you look to, post the Fed meeting, the Fed really would like to have their next move be a rate cut. But again, it's all the data dependent on inflation and where things go. But the market's concern over inflation continues. And again, it's going to be something to watch to determine if the correction will continue or not.
Yeah, Jared, I think with the Fed, one area again of kind of looking ahead and just to recap the Fed policy meeting. So interest rates remained unchanged, but the one change that we did see is the tapering of the balance sheet. So the Fed was rolling off, the Federal Reserve was rolling off about $60 billion a month in treasuries. And you can see that since COVID, there was about $4 trillion of assets on the Federal Reserve balance sheet. In COVID times, that number jumped to 7 trillion. And then it continued to grow, which many argued, did not need to be the case. And then the Federal Reserve started tapering. They got down to just over 8 trillion. They added a little bit back as a result of the banking crisis last year, and then really got back onto that path of tapering and basically pulling money out of the financial system to, again, reduce inflation. What they're doing now is reducing the trend and the pace of that tapering. So again, what that's going to do is allow more liquidity to stay in the markets, and will give the opportunity for folks to, again, pursue growth, and really provide additional support to the financial system.
And when you think generally, David, as you said with the balance sheet, when the Fed's putting money in, if you think about the mechanics, as the Fed's forcing liquidity in the system, it forces more risk into the system. Now that they're have been tapering, they took 2 trillion out. That's drained a lot of the risk out of the system because as they're not buying the bonds, other investors have to jump in to buy the safer assets. Now, as there is less demand for investors to buy those safer assets as they taper, that could offer more risk taking in the overall system as the Fed navigates, exiting some of this, but then also to a path to cutting interest rates. So we'll see what the impact is because there's a little bit of surprise in the Fed meeting that they did taper this month because of the inflation concerns, but they will start that next month in June. And then they're just going to continue to be very data dependent on inflation. This morning we had the monthly jobs data, which again was a decent number, but it missed expectations overall. So you have this feeling that the economy is still in good shape, but it's not as robust, and the inflation pressures that maybe mounted in the first quarter, at least April and beyond, are going to be maybe not as big a concern. And the same thing, David, when you look at first quarter GDP, right? GDP missed expectations overall, despite the fact that you had much higher projections.
Yeah, Jared. So if you kind of look at GDP historically, and then looking ahead in 2021, you saw GDP was very strong. Again, it was catching up from COVID. The first half of 2022 is where, we saw the slowdown in the economy. You saw the markets enter a correction as well. And so the question is, was this kind of that unofficial recession? It was obviously never announced. But then economic growth picked back up. And so if you look at then what happened last year, again, strong economic growth really picked up in the second half of the year. But then, like you said, JR, the first quarter estimates, if you look at the Atlanta Fed, which has been historically very accurate, was a higher number. Economists also anticipated about a 2.5% rate of GDP growth. What we saw in terms of actual numbers was about 1.6. And so the question now looking ahead is, where is GDP going? The estimate from the Atlanta Fed right now is about just over 3%. This number could change. And then looking ahead, we're getting back into that normal economy of, 1.5 to 2% GDP growth. And that's to be expected for the largest economy in the world. It's very hard to find for productivity improvements and just general growth when it's such a large economy overall. But again, still remaining strong with a positive outlook. And as you look ahead, and this is likely what the Federal Reserve is looking at as well, is where they likely see the opportunity to then, have some of those rate cuts that they've talked about.
Well, and again, you look at that outlook, David, the growth is kind of in that plus or minus 2% range. And when you look at first quarter inflation concerns, they were definitely worse than expected. But take gasoline. Gasoline was up over 30% in the first quarter. It was flat in April. So there's good reason to believe that there is a path for inflation to ease. Obviously, it could change, month to month as we've seen. But between the slowing labor market this morning, wage inflation was the first month in a while below 4% as far as wage inflation. So there's good reason to believe there is a path that the Fed could navigate this, because the concern we have as the Fed starts cutting rates, what is going to be the reason why they cut? If they're cutting because the economy is steady and inflation is getting back to the 2%, it's probably a good sign for the overall economy. If consumers start to pull back because the April weakness and still the inflation overhang, if the Fed starts cutting because of a slowing economy, that'll probably be a bad reason for stocks, risk assets overall. So these are going to be the things to watch for in the weeks ahead. Now, as you kind of look to the opportunities within the market and earnings season overall, as we sit here today, we're probably 2/3, maybe 70% of the way through earnings season. And for the most part, the results have been pretty steady, right? And again, I think companies have focused as we thought coming into this year. Top line growth is starting to slow. Even the momentum names where you had excessive growth, as that growth slows down to, lower double-digit numbers, you're seeing a revaluation as well. And companies that are maintaining margins are being rewarded. So even though top line growth is slowing, we're able to keep margins, and that seems to continue to be a pocket of opportunity within the markets.
Yeah, Jared, where do you see opportunity kind of within fixed income, and what are you looking for there?
Well, if you look at the fixed income markets, again, as you pointed out, David, I think keeping shorter duration and high coupon fixed income has really protected investors. As interest rates have moved up in the month of April, it's a good opportunity to extend duration, lock in those yields for a little bit longer at this point. But again, as investors consider rebound, still not a bad time to be taking some profits, locking that income from the growth over the last few years. We continue to see that as a good strategy. Value stocks are back, at least over the last 2 months. So valuation is going to continue to matter to the market, we believe. Dividends are a little bit attractive. And again, the momentum out of the top 8 or 10 names, some of it still persists within a few of those, but it's much more of an even stock market at this point. And again, you saw a lot of mergers and acquisitions pick up in the month of April as well. So there continues to be a lot of activity throughout the market. So looking ahead, I mean, I think it's a much more selective market, but again, where companies are able to maintain margins, that's where we continue to position and look to the end of the year. So with that, we want to thank you for tuning in this month, and we'll touch base next month.
Thank you.